Welcome back to The Explainer. Okay, let's dive into this. Today, we're exploring one of the most fascinating economic mysteries in American history. Picture this, right? Today, a central bank is considered absolutely essential to any modern economy. You wouldn't even question it. Yet, for nearly 125 years after its independence, the United States literally didn't have a permanent one. There was no institution managing monetary policy, no lender of last resort, and absolutely no organization standing by to stabilize financial markets when things went south. In this explainer, we're going to unpack exactly how America rose to become an absolute economic powerhouse, totally without a central bank.
Consider the stark contrast between then and now. I mean, if you walk down Wall Street before sunrise today, you're going to see these massive electronic trading screens lighting up the dark, all backed by the immense safety net of the Federal Reserve and modern monetary policy. But jump back to that massive 125-year stretch of early American history, and wow, it's a completely different world. Imagine horse-drawn wagons instead of automobiles. Imagine merchants physically carrying around heavy bags filled with gold and silver coins. In this decentralized era, private banks just open their doors every single day without any nationwide monetary authority acting as a safety net.
And that leads us directly to the fundamental question driving our investigation today. How did the economy survive? Seriously, how did commerce actually keep moving? How did a collection of fragile, newly independent colonies finance massive industries, expand westward, and grow into one of the world's largest economies without a central monetary authority pulling the levers?
So, let's get into Chapter 1, the central bank mystery.
You see, to really understand this, we have to look at the deeply ingrained mindset of the young nation right after the Revolutionary War. Early America's finances were incredibly fragile, and honestly, there was a fierce, deep-seated distrust of centralized financial power. Because of this, early economic survival didn't rely on Washington, D.C. Actually, scratch that, it couldn't rely on Washington, D.C. Instead, it leaned heavily on the Constitution's monetary framework, highly localized credit markets, and literally thousands of private, daily decisions. Economic growth was driven from the ground up by early merchants and small private banks in colonial marketplaces and busy ports, rather than just being dictated from the top down.
So if growth was completely decentralized, what was actually fueling it? Let's look at the mechanics in Chapter 2, the engine of trust.
To understand early banking, you absolutely have to understand this concept called specie, or hard money. We're talking about actual physical gold and silver points here. In a world with countless different currencies and local notes just floating around everywhere, these precious metals were the ultimate bedrock. When a private bank issued a paper banknote, it was supposedly backed by the specie actually sitting in their vault. Public confidence in that hard money is exactly what allowed different notes to be exchanged and international trade to function. The confidence in the metal was often just as important as the metal itself.
And this brilliantly illustrates how this localized credit loop functioned in practice. Step 1, a community or state-chartered bank issues notes, backed by that hard specie we were just talking about. Step 2, a frontier farmer or local entrepreneur walks in and secures credit. Step 3, they take that credit and use it to invest in agricultural expansion or a brand new business. Step 4, that localized investment sparks real economic growth that enriches the entire community. It was this beautifully localized cycle that encouraged incredible entrepreneurship completely despite the lack of a national authority.
And you know what? The results of this localized loop were absolutely staggering. We're talking about massive, massive infrastructure projects here. Canals connecting vital waterways, the transcontinental railroads spanning the entire country, expanding telegraph lines, rising factory production, and huge, large-scale agricultural growth pushed by a wave of immigration. The key takeaway here is that millions of everyday entrepreneurs, immigrants, and local investors financed this monumental development completely on their own. And they did it long before a nationwide monetary policy even existed. An early American merchant perfectly captured the essence of the era with this quote: "A bank's greatest asset wasn't money, it was trust." This entire highly localized system, from the farmer getting credit to those massive railroad projects we just mentioned, functioned entirely on public confidence. Trust was the connective tissue holding the whole shebang together. If you believed the local bank had the gold in its vault, the system worked beautifully.
But relying so heavily on decentralized trust had a dark, incredibly volatile downside when confidence wavered. Which brings us to Chapter 3, panics, runs, and crashes. Now, what's really interesting about this slide is just the sheer frequency of these events. It's staggering. Look at this timeline: 1819, 1837, 1857, 1873, and 1907. These financial panics and massive credit shortages, they weren't rare anomalies at all. They were a recurring, built-in feature of a system that lacked a lender of last resort. When fear struck, it spread like wildfire, way faster than prosperity ever could. As one early business owner warned, without confidence, even healthy businesses could fail. Imagine the tension in the air. The very second a rumor started that a bank didn't have enough specie, massive crowds would gather outside the doors. Bank runs led to completely empty vaults. When the banks collapsed, local credit vanished instantly. Newspapers would report total financial collapse, which led to devastating factory shutdowns and sudden, massive unemployment. And remember, there was absolutely no government safety net to catch anyone.
So, in the absolute absence of a central bank, who stepped up when the system was on the brink of total collapse? Let's turn to Chapter 4, the private rescuers.
To survive these severe crises, America had to rely on impromptu stopgap measures. Local clearinghouses, business cooperation, and state governments would desperately try to organize emergency lending. But during the worst panics, it fell entirely to private individuals. The climax of this era was the Panic of 1907. Things got so bad that wealthy private financiers, most notably J.P. Morgan, literally had to lock bankers in a room and personally organize rescue efforts. Morgan acted as a makeshift central bank to prevent a total systemic collapse. It's a slightly terrifying reality that the fate of the national economy rested on locking a few wealthy guys in a library until they agreed to pay up to save the system.
As one historian perfectly summed up the precarious nature of the era, America survived, but often by relying on private leadership instead of public institutions. It's just wild to think about. The economic survival of a rapidly growing nation depended incredibly heavily on the personal wealth and the willingness of just a few private individuals to intervene when things got totally out of hand.
Eventually, the sheer complexity of the expanding economy demanded a structural pivot. This brings us to our final chapter, Chapter 5, the shift to centralization.
Following the Panic of 1907, intense congressional hearings and political debates really took center stage. Business and political leaders alike realized that this repeated financial instability was simply too dangerous for an expanding national economy. Add in the pressures of international competition, and well, there were massive demands for a permanent crisis response institution. Impartially speaking, the system had just grown far too large and complex to rely on private bailouts anymore. And that brings us to this pivotal year right here, 1913. This was the year the Federal Reserve Act was passed, marking the official end of the era we've been exploring. A permanent central bank was established, shifting the United States away from the localized hard money system it had leaned on for over a century.
Pre-1913 was the decentralized era, defined by a reliance on local trust, frequent panics, and private crisis management. Post-1913 ushered in the centralized era, defined by modern monetary policy, financial regulation, and managed stability. So, the crucial point is this. Historians and economists still debate the different interpretations of this shift today. They continually analyze the Fed's long-term impact on economic growth, stability, and inflation, comparing it to the untamed, explosive expansion of the 19th century.
But as we wrap up this explainer, consider this. Institutions evolve and currencies change, but beneath every single transaction, whether it's a heavy gold coin, a handwritten 19th century banknote, or an instantaneous global digital transfer today, lies the exact same foundation, trust. Long before a central bank existed, it was the raw trust between individuals that built a nation. And you know, trust remains the absolute true currency of every economy today. Which leaves us with this final, provocative thought. Knowing what you know now about the explosive growth and the terrifying crashes of the decentralized era, could an economy as massive and complex as America's function today without a central bank? It's a really fascinating question to ponder. Thanks for joining me on this explainer. Keep asking those big questions, and we'll catch you on the next one.